Friends, today I would like to talk about the importance of having international equity investments in your portfolio. Why you need to have it? Basically, it is the asset allocation. It will give you diversification beyond India in the international equity class. And second, it also gives you the currency depreciation is taken care. What I mean is that when the Indian currency goes down, when the pegged against US dollar, so you get international equity return plus dollar denominated returns also in the portfolio when you stay invested for the long term. Because as you know, the dollar index and dollar is one of the universal currency, and India is not our currency is not a international currency. So when we buy products from abroad, it is always done through a US dollar predominantly. And second thing, most importantly, if you look at most of the companies based out of US, if you look at whether we are using the Amazon products on a daily basis, we search through Google, we use Apple phones, we use Microsoft software, and what next, whether it's Zoom app or Microsoft Team, whatever you call, it is all these companies are originated from US and other developed economies, right? So international equity provides you enough diversification, and it will give you asset allocation, could be a part of your portfolio at any point in time. How much to do? It is purely based on your goals. So this investment should be done based on your children's education goal. Some part of that can be in India, some part can be in abroad, so that when you send your kids for higher education, this dollar denominated return also helps you to have a higher return in the portfolio apart from diversification, right? And in the mutual fund route, how to choose those funds? Basically, if you look at, there are funds which are country specific, there are funds which are brand specific, there are funds which are broad based. It could be a combination of investing in all the developed economies or in all the emerging economies. When I say developed economies, it includes US, Japan, German, and England and others, where they will invest in those growth economies, or in the emerging market economies, especially like China, Taiwan, Indonesia, Malaysia, even our country, India, Brazil, and others, right? So you can have a combination of both developed economies as well as emerging economy in the part of your portfolio to have a wonderful diversification within the international equity space. And there are also options. It can be, some of them are feeder funds, where the funds will collect money from here and give it to the fund manager who is managing abroad. And some of the funds are index based, where they will track an index. It could be a NASDAQ, or it could be S&P BSE index, like that. Or there are some companies which will be a feeder fund, where there will be different pockets available in different countries, where all those money will go into that feeder fund. For example, if you look at Invesco as a mutual fund offers feeder fund, and Motilal as a fund house gives you index investing through S&P 500 or NASDAQ. And there are some direct equity investments which directly invest in actively managed funds, something like an ICICI US blue chip fund, or a Franklin US opportunities fund, right? So there are plenty of options are available. Definitely you should consider that. If it is not part of your portfolio, it will definitely help you in the long run. And the minimum investment horizon, if it is a lump sum, it has to be 5 years, and for SIP, it has to be 10 years. That is where you will see the growth coming into your portfolio. And to understand how much of an asset allocation can be part of your international equity, do get in touch with us. We'll be happy to help you in planning your portfolio. Thank you.